Cathie Wood is one of the most famous investors in the world, especially in the area of disruptive technology, where her flagship Ark Innovation ETF had grown at one point to nearly $30 billion of assets under management before crashing all the way down to less than $6 billion today during the current stock market collapse that we're currently going through. However, Cathie is also famous for buying heavier when those stock prices go down. And some people absolutely love her. They think she makes great choices and they like her strategy, while others feel that she's a very poor investor who makes bad decisions and invests money in bad companies. Time will tell who's right about that because she claims to be a very long-term investor. But here in the meantime, in today's video, I'm going to show you right now the top 5 largest purchases that Cathie made for her flagship ETF over the past month. And to make things even more fun and interesting, I'm also going to rank them from best to worst based on my own opinion, and I'll even let you know if I plan to buy any of these stocks myself anytime soon. Should be a ton of fun. I hope you guys enjoy the video, and if you enjoy these type of videos where I review the moves and the actions that big investors are making in the market, then please let me know by hitting that like button or subscribing to the channel. Those two things really help keep my channel alive and it means the world to me, so thank you for all that support. But with all that said, let's go ahead and jump straight into this list. Alright guys, and counting down here from smallest to largest purchase over the past 30 days, coming in at stock number 5 is going to be a company called Ginkgo Bioworks, ticker symbol DNA, which Cathie purchased over 3.8 million shares of at an estimated value of somewhere around $6 million based on recent share prices. Now, this is a very unique stock here that rarely anyone talks about, and in fact, this could easily be classified as a speculative stock as they consistently lose even more money on the bottom line than they even do in all their sales, which is pretty bad. And while revenue can sometimes soar like it did by over 40% in 2020, 300% in 2021, and still 50% in 2022, it's now expected to drop by negative 20% this year, which is not a great sign considering that they are still not profitable. And this type of uncertainty or kind of volatility is reflected in the stock price as it initially soared to almost $16 a share after IPOing in 2021 before crashing straight into the ground by about 90%, leaving it now just around the $1 range. So is Cathie wise to scoop up shares at today's lower prices? Well, analysts seem to think so, as the stock is currently trading significantly cheaper than Wall Street estimates. In fact, even the lowest price target is still double where the stock is trading today, and the average price target is more than triple the price, while the highest is more than 8 times the price. But what does DNA even do, and is it a viable business that can turn things around over the long term? And when I say DNA, of course, I'm talking about the company, and that's referring to the ticker symbol. Well, as is implied with that ticker symbol, DNA, Ginkgo is, of course, a biotech that focuses primarily on 2 giant parts of the healthcare market, those being security and manufacturing. For example, their biosecurity segment has helped with things like public testing during the pandemic, while also working with the US government and intelligence agencies on national security projects like detecting bioengineered DNA that can be used to target and damage human populations. On the manufacturing side of things, their BioFoundry segment helps businesses run more efficiently by providing biotech assistance. For example, they help the plant grower Kronos produce more cannabinoids by splicing the genes that can later be cultured through their bioreactors to produce giant quantities, much larger quantities that Kronos can later use for their own products like edibles and vaporizers. It's all very impressive work, and it usually combines robotics, machine learning, and mass-scale biological technologies that are hard to replicate, thus ensuring a strong barrier to entry and a competitive advantage for Ginkgo. It also means that they are likely to benefit from economies of scale over the long term, so while they're not profitable at the moment, that might eventually change into some very strong margins over time. Right now, all their sales are being put back into the business in order to grow and expand, like opening 15 new BioFoundry programs last quarter alone, bringing the total to 85 across 43 customers. But over time, These programs should snowball on top of each other and be used across various customer needs, which I think will help their profitability. I still need to research this company more myself, but as of now, it's clear that Cathie Wood believes in their future potential, and while it remains heavily speculative with a price to sales ratio above 4, I actually kind of like it as a high risk kind of spec stock, and I'm just going to go ahead and put it in the middle spot at number 3 for now until I see what else is on the list. But I won't be buying the stock myself yet, as I still feel that it's just a little too risky for me personally. Moving on to stock number 4 though, that's going to be one of the most popular tech stocks to emerge out of the pandemic in the video communications giant Zoom, ticker symbol ZM. And over the past month, Cathie purchased over 90,000 additional shares for the ETF, valued at over $6 million. In fact, Cathie loves Zoom stock so much that over time, she's turned it into her number one largest holding at over $500 million, even ahead of Tesla, which is the stock that she has always been the most famous for being bullish on. And during the pandemic, it looks like a great play as the use of video communications skyrocketed, shooting both their sales and profits up to new record highs. Virtually everyone that was working or learning from home was using Zoom, which grew their sales by 88% in 2020, a massive more than 300% in 2021, and then still another 55% in 2022, despite all that previous growth. However, from here, everything is now slowing down as workers and students return to in-person meetings. Don't get me wrong, video conferencing is still in extremely heavy use and will likely continue to grow over time, but the actual growth rate is falling to just the mid-single digits in each of the next 2 years for Zoom, while profits by EPS are actually declining by an average of 10% over the next 5 years as well. The result of which is that the stock went from being a high flyer that reached nearly $600 a share to now crashing straight into the ground, losing almost 90% of its entire value, down to just around $70 or so today. And normally I would have a very open mind to a turnaround play like this, but there is one simple reason why I have never been interested in owning Zoom stock myself, and that is the competition. Now, there is no doubt that Zoom is still the world leader at over half of the entire world market, but giants like Microsoft, Google, Apple, and Facebook, Facebook parent company Meta, have been rising the ranks, with Microsoft already claiming more than a fifth of the market, and the rest together make up almost another 10%. And so my question is, if I want exposure to video conferencing, why not just go with one of those other giant stocks that are much larger, more profitable, and more diversified? For example, Microsoft and Google both generated over $300 billion more in sales last year. They have double-digit revenue growth versus single digits for Zoom, about double-digit EPS growth versus negative double-digit growth over the next 5 years, and yet both companies are actually trading cheaper than Zoom 2 at a PEG ratio below 2 versus Zoom at almost 3. So as much as I'd love to give Zoom a shot, I just think they're not very necessary, and they don't offer anything that I don't already have, since I'm actually invested in most of their competitors. So for that reason alone, I actually have to rank them below Ginkgo at number 4, because I just have no real reason to own it. Okay, at stock number 3 though is another tech stock that Cathie has been a longtime proponent of, in Roku, ticker symbol ROKU, which she purchased another 153,000 shares of, equating close to $7 million over the past month alone. And in all, it makes Roku her 5th largest holding in the ETF at over 6% and worth close to $400 million. And I'm sure you guys know this one, as they're also a fairly popular stock, known for their very large video streaming business that operates through a television operating system as well as an actual streaming app called the Roku channel. Now, the operating system is sold through their standalone Roku devices, but more recently, it's been primarily implemented into smart TVs known as Roku TVs, where they are able to charge certain fees from the TV manufacturers, as well as the various apps and streaming channels that want to be listed on it. And they're even building their own TVs now too that are set to release later this year, which is pretty crazy. Now, the Roku channel has also seen a lot of success as it's not only partnered with other streaming channels that want to operate through it, like Showtime, Cinemax, Paramount, and more. You can get all of those kind of combined into your Roku channel and have it all in one place, but also just from the fact that it has a free ad-supported version that has already become the #1 market share leader in the US, which is a huge deal as that market is actually estimated to surpass the paid subscription model over the coming years. All of that success initially sent their sales soaring, especially during the pandemic, where they even reached profitability for the first time last year. However, things quickly changed coming off of that, with revenue growth now slowing down to just 10% this year and mid-single digit growth next year, while their earnings per share are also crashing by over 300% this year, leaving them once again with no price to earnings ratio. And thus, after the stock initially skyrocketed to almost $500 a share, it has now crumbled to below 50, losing more than 90% of its entire value. And I can really summarize this as being very similar to Zoom. This is a stock that could have turnaround potential, don't get me wrong, and I would consider buying it maybe in other circumstances if it wasn't for the giant competition. Not only are there tons of regular streaming giants out there like Netflix, Disney, Amazon, and more, but many of them are even launching ad-supported versions too, including the biggest threats of all with Netflix and Disney. And even in the smart TV OS market, while Roku still commands the most share in America, it trails globally behind Samsung, LG, and Amazon, with Google's Android right on their tail too. Plus, there's even Apple and other giants as well. So it's just super competitive overall. It's hard to bet against them after the stock has crashed by so much, but like Zoom, I would much rather own the competitors like Amazon, Google, or Apple that are so much larger and more diverse. And by the way, I actually do own all of those. So I'm going to have to rank Roku at #5 as it's even less appealing to me than even Zoom. Alright guys, we are now down to the final 2 stocks of the list, and coming in at #2 is going to be a hotly debated one right now because of the whole FTX scandal, and that is the cryptocurrency exchange Coinbase, ticker symbol COIN, which Cathie purchased another 255,000 shares of for the ETF, valued at somewhere close to $10 million. And that's because, like the others, Coinbase stock has also crashed by monumental amounts, losing more than 90% of its entire value. Now, there's a couple reasons for this. For one, Coinbase is actually the second largest crypto exchange in the world, only behind Binance, and during a boom in crypto prices, this would be a fantastic market to dominate, which is exactly what we saw in 2021 when the price of Bitcoin soared to a new record high. However, cryptos being as volatile and unpredictable as they are, coupled with the world economy as a whole just being a complete disaster in 2022, well, the price proceeded to crash back down, all of which is perfectly reflected in both Coinbase's financials as well as the stock price. In fact, revenues skyrocketed by more than 6 times in 2021, but are now projected to fall by over 30% this year and another nearly 10% next year, which of course coincides with the performance of the stock. On top of that, the FTX collapse has shaken the entire crypto market, which on one hand, that could actually turn out to be a positive for Coinbase because they've been able to gain users that used to use FTX, but on the other hand, some analysts think that the collapse has caused many potential investors to lose confidence in cryptocurrencies, thus setting back the adoption of the currency by somewhere, around maybe at least a couple more years than it otherwise would be, which of course would hurt the broader crypto market. But my personal reason for not owning it is simply for the same reasons as the other stocks on the list, that being competition as well as a ton of other investment options. Some estimates even say that there are over 1,500 crypto exchanges around the world, with even a ton of non-crypto related brokers now offering cryptos as well, like Robinhood and SoFi, for example, which I happen to own both of those stocks as well. Plus, if you really want exposure to crypto, you could always just buy some Bitcoin, Ethereum, or any other coin you like without having to actually invest in a stock like Coinbase. So while I totally understand why some are taking a chance on it, don't get me wrong, I can totally understand that. But I just personally have no real reason to own it myself. So I'm actually going to put them at the bottom of the list at #5, and I'm going to move the others up 1 spot to fit it in. Alright guys, and no surprise here, the stock that Cathie Wood has been purchasing the most amount of recently at number 1 is also the stock that really gained her the most popularity for being so bullish on it, and that is of course Tesla, ticker symbol TSLA, which she purchased over 600,000 more shares of for the ETF, valued at about $75 million. The move is fairly obvious considering she's always been one of the biggest Tesla bulls out there, so seeing the stock crash now by over 70% is probably just too tempting for her to ignore, especially considering that Tesla has actually been selling every single vehicle they can make, with sales soaring by over 70% in 2021 and are still expected to grow by over 50% in fiscal 2022 and 34% in 2023. They even started to turn a profit in recent years, and unlike the other stocks on this list that are seeing theirs plummet coming out of the pandemic and given all the recession fears, Tesla, on the other hand, is actually expected to grow their EPS by almost 35% on average over the next 5 years. Meanwhile, their margins are industry leading and gigantically higher than the legacy competition, while their stock valuation has plummeted down to just about a 1 PEG ratio thanks to all that growth. That's not only 23% cheaper than the sector, but it's also about the same as some of the legacy competition like GM, which all the bears have always argued as being so much cheaper than Tesla. Granted, the biggest threat to Tesla's stock right now is that there may be a looming recession right around the corner, which will likely hurt expensive luxury vehicle sales. And Elon Musk himself is probably not helping the situation by, becoming a little bit more of a polarizing figure recently, with liberals actually starting to dislike him who used to love him. But I think both of those issues could actually be offset by the record high EV adoption rates given how expensive gas has become, while a decrease in liberal sales could also be offset by new purchases from conservatives that are now in love with Musk and may have otherwise never even been interested in owning an electric vehicle until now. So it's a little bit of a toss-up, it's hard to predict, but Tesla is actually one of my largest holdings in my own portfolio, and I still believe in their future of autonomous driving and other things, and I'm trying to just kind of ignore all the drama and just focus on the business. So I'm gonna have to rank them at number 1 just because I'm not a very big fan of anything else on this list, to be honest with you. So there you have it, guys. Number 1, I put Tesla. Number 2, I put Ginkgo, which is, super risky, but at least offers me something different that I don't already have, compared to the other ones. And then at number 3, number 4, and number 5, I just put Zoom, Roku, and Coinbase, who I feel I just have no real reason to own them myself. But those are just my own personal thoughts, guys. What do you all think? How do you feel about any of these stocks? How do you feel about Cathie Wood? Do you own any of these stocks? Have you ever considered any of these? Do you agree with my ranking? I'd love to hear your thoughts down below in the comment section, and I'll respond to your comments as well. Thank you for all the support, everyone. I hope you're all having a great time, and I wish you all the best, and I will catch you in the next video. Take care, my friends. Bye-bye.